AT&T, stock ticker T, and Verizon have seen valuation pressure related to rumors that Dish Network is partnering with Amazon to sell wireless plans. AT&T's share just made a new 2023 low, and the yield actually surpasses the company's price to earnings ratio at the current time. However, AT&T have confirmed its free cash flow forecast for the fiscal year of 2023. In this video, we want to take a closer look at the intrinsic value of AT&T to see whether or not it could be a potentially good time to enter the stock. You can see year to date they are down 17.3%. Over the last year they are down a whole 27%. But there has been some ups and some downs, so it could potentially be a pretty good time right now because we are what seems to be in a valley. Also, taking a closer look back at the dividend history of AT&T, you can see that they actually cut the dividend between January and April. So now it seems like there could be a really good time actually for them to build it up again with some solid growth instead of having this overpriced quarterly dividend they couldn't sustain. But as always, we jump into our stock screen. I'm punching the stock ticker, which was, as mentioned earlier, just T, and you can see everything is auto populating. We do have AT&T with the current price of $15.50. The PE ratio is non-GAAP forward ratio of 6.23. The dividend yield is 7.16. So as mentioned, it's actually above the PE ratio. The short interest is not that great actually, which is kind of surprising how low that AT&T are at the current levels. The 52-week low is 14.4 and the 52-week high is 21.5. And the analyst target price is actually above 20. So there could potentially be a good time to enter at the current level with a nice 25% upside. However, the EPS growth and the return on equity seems very bad at -22 and -8.5. But let's jump into the dividend data tab and zoom in a bit so we can see everything a little bit better. You can see here the dividend growth rate over the last 10 years is -4.7%, which is again in line with what we saw earlier with the dividend being cut. So everything here is a bit hard to look into because you can see the recent numbers up here are negative, mainly due to that dividend cut. So we can't really do anything with these numbers, I believe. But we can scroll down a little bit to the dividend yield theory graphs where you can see that the dividend yield has actually dropped a little bit with the price. And you can also see when we are down in the red, it could indicate that the stock is overvalued. So at the current time, at least according to dividend yield theory, there's really not a good time to buy into AT&T. But we do have a lot of other different valuation models. The first one being discounted cash flow model, where we do take the free cash flow from the different years. We then calculate a growth rate based on these. I've chosen 5 because I seem to think the average growth rate is a bit above 5 as well, and they have confirmed their free cash flow. So I think this is a pretty okay standpoint to go out from. Then we do use that to project the future free cash flows, which we can then discount back to the present value using a discount rate of 9%. Combining all this with the cash equivalents, the total debt, and the shares outstanding, we arrive at a fair value of $17.06. The next one is the dividend discount model, which is a bit difficult to use because as you see here, we do have the dividend payout, which got cut in the current year. So the growth rate is obviously at a very negative, but I think going forward, they can probably sustain it at a growth rate of maybe, let's say 2%. Combine that with a weighted average cost of capital of 8%, the intrinsic value is around $19. Next one is multiples valuation, where we compare it to similar companies such as Deutsche Telekom, Verizon, and so on. And we arrive at a stock price that is negative, mainly due to the EPS being negative. So I will exclude this in the summary when we get to that. The next one is a new model I've made, price to earnings valuation, where we do take the price to earnings ratio over the different years. We then take the 5-year average, combining with the trailing 12 months at the current time of the PE ratio calculation, we do arrive at an EPS from the 12 months before. Since the last one is negative, I do use one from 2022, which gives us an intrinsic value of, again, $17. Having also the Graham's revised variation model, where we do take the EPS of the company, PE of a noteworthy company, combine it with the growth rate, a average yield of AAA corporate bonds, and the current yield of AAA corporate bonds, we arrive at an intrinsic value. But again, since the EPS is negative, we arrive at a negative intrinsic value, so I will then exclude this one. The next one is the price to free cash flow valuation. So we do take the price to free cash flow ratio, have all those from the different years, combine them together to find an average. We then take the free cash flow per share, combining with the average, and arriving at an intrinsic value of $13.94. The last one is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the price to earnings ratio of AT&T, combine all those together, arriving at an intrinsic value of $16.22. Before we jump into the summary, thank you so much for watching. If you haven't done already so, please subscribe to the channel and like the video. And let's jump into the summary, where we do have all our valuation models. Now we also have the PE model as well. I do want to exclude the two that are negative, which then gives us an average intrinsic value of $16.6. With the current price being around 15.5, there could be a potential average current discount of around 7% at the current time. If you put in a slight margin of safety of, let's say, 10%, the acceptable buy price becomes $15. I think this is a company where you can buy it only for the dividend. I do think they have a very huge debt, so personally I would not touch it. There are way better companies out there in my opinion. AT&T's earnings from their continuing operations have been flat for 10 years. They pay a healthy dividend, but the company isn't growing, so that's not really something I really want to get into. So if you do like the company, go do more research. I think it's very, very close at having an attractive intrinsic value. It does have a very nice dividend. Personally, for me, it's not a buy, but if you're out there and want to invest in the company, it couldn't be too bad of a point to do it at the current levels. Thank you so much for watching. I'll see you in the next video.